Hello, Oracles. Well, we got the CPI data today, and it came in exactly in line with expectations. We got 7.8% year-over-year inflation. We got 0.8% month-over-month inflation. So the market, obviously, as we know, went red. Sorry I got to wear my green shirt a couple of days. What does this mean going forward? It means that we are kind of anticipating what's going on. The market has priced in where inflation currently is. We have the FOMC meeting next week, which is going to give us a little bit more clarity. Jerome Powell had told us what the plan is for the Fed, and next week we will just make sure that he reiterates that and actually follows through with what he had told us previously. If that is the case, we may not see anything really come out of next week. I think we're still going to see the fluctuations as we have. Up one day, down the next, kind of overall sideways trading, nothing really moving in one direction or the other. And in having a conversation with Slim, he posed a great question in the comments about, what are we looking at going forward? We know that next month's CPI data is going to be much higher due to gas prices and oil prices going up due to the Russia-Ukraine situation. So what are we looking at going forward? Are we actually going to see any sort of rally? Because big money, we know, is sitting on the sidelines right now. They may have a little bit of money in there, but they know themselves that inflation is still really high. We still need to get that in line. The Fed has to raise rates. That's going to lead to uncertainty. So putting a lot of money in the market right now is just not wise for them. Meanwhile, many of us retail investors have been buying the dip and dollar cost averaging, but as Slim mentioned, many of us are running out of cash to invest. Heck, even myself, I took a step back and I didn't invest as much as I had been because we're kind of in a downward, sideways trading market right now, and I was running lower on cash, so I'm just waiting to see if maybe we dip down another step. And it kind of seems like month to month we've been taking a tier step down and then trading sideways and then doing it all over again. And that may keep on going forward as the inflation keeps going up. So, how do we do this? Do you hold cash right now? Do you continue to dollar cost average? This is why being an Agile investor, something I had talked about many a time before, is so important to do. Because being an Agile investor doesn't mean you're changing your decisions or you're not sticking with your plan. It's you have to change. You will lose if you do not change as the market changes and as you get new information. So as I have seen the market trading sideways and kind of taking those steps down, I've decided, all right, I'm only going to invest so much in this trading range and then I'll see where we go next. And if we dip down, then I'll add a little bit more. But I'm sticking with my plan of 5% cash. I went below that, so I held back on my trading until I build back up to that 5%, and then I can go back to increasing my investments accordingly. So this is how I'm playing it, still monitoring it, because you don't know what's going to happen. We may all of a sudden one month get, inflation went away, or hey, the Fed's interest rates going up are, really actually changing the market and the inflation. Then we might see some more big money come into it. But even when big money sees it and they start to put money into it, I still don't think they're just going to dump all of their money in and we're going to see a V-shaped recovery. I think we're going to see a slow climb out, but we will see some winners run away faster than many others, and Tesla is one of those. What do? We now have seen almost 8% inflation. We're most likely going to see probably 9% inflation or higher in April based upon March's numbers, which is going to just be absolutely insane. Oil prices are still high. So how do we invest? As I have said, I'm still sticking with my 5% cash rule, investing everything else. So when I look at building wealth, I like to compare it to the World Strongman competition. And if you've ever seen one of those where they've got a rope tied to a bus or a train or a plane and they're pulling this rope along, what do they have to do? As you're watching them pull the rope, if they're pulling it with a lot of slack, they don't get the train or bus to move very far. They have to reach far in and then pull. And when they reach far in, that gives them better leverage to be able to pull that vehicle further. And so I relate that to the market now because we're now in a downward cycle. And now is the time where you want to leverage your portfolio. You don't want to use margin. That's not the kind of leverage I'm talking about. But this is the time where you want to invest. Because if you're investing when the stocks are running up, that's like you're pulling the rope with a lot of slack. And you're not really going to get very far because the stocks are already running. But when you've got the stocks depressed like they are, and you invest your money, that's like when you've got a good solid handle of the rope, no slack, and you can really get that machine to move and that vehicle to move towards you a lot faster because you don't have that slack. That's where we're at right now. I don't know if we're at the bottom. I'm sure we can go down further, but we don't have a lot of slack. There's not a lot of slack in the rope right now, so we can really make a lot of gains with the money that we invest now. Obviously, you don't want to dump a lot of money in because we can pull back further. But investing a little bit now is good because that's going to give us better leverage and better return on our investment later. And so then going back to Slim's thoughts on this of, if the retail investors aren't investing as much money and there's not as much money flowing into the market right now, that leads me to believe that the market may pull back a little bit more. But I also don't see a lot of people selling much because I think we're kind of at the point where, the paper handers are gone. We're not going to have any more paper handers. Whoever's sold is going to sell. Most of the market trading right now is a lot of, options and day trading. And there's a lot of just people holding right now because they can't invest more. So as we watch the market, there's going to be lower volumes. There's not going to be as much money flowing into the market. So stick with whatever pattern works for you. And if we do dip down a little bit more because inflation goes up more, I will just add more. So this is why dollar cost averaging is still the best way to go. But if you're dollar cost averaging with too much money and you run out of cash, that may be detrimental in the long run, as you won't be able to invest as much if we dip further down. So just be agile, make those different adjustments to your portfolio, make those adjustments to whatever cash you're putting in, maybe sell off a couple of losers to get some cash, or if you do have anything go green and positive, then go ahead and sell that as well. Again, not financial advice. This is just stuff that I am doing in my own portfolio, and it seems to be working well for me. And obviously, we won't know until probably the end of the year or beginning of next year to see how these investments are going to change our portfolios. But if you're investing in companies that you believe in long term, you're investing on a daily or a weekly or a monthly basis, whatever the dollar cost average is best for you, when we do come out of this, and we will come out of this, when we do, you're going to reap those benefits and you're going to have that extra leverage because you weren't pulling the rope with any slack. And now one can also argue that if we are not going to come out of this dip in a fast manner, you can wait till we actually have signs of us coming out before you invest. Again, that's another strategy, more on the timing side of things. But when it comes to dollar cost averaging, if you are running low on cash and you want to wait, may not be a bad thing. Save up that cash. You're not going to lose any time. I still think there's a long window of time that we have to invest. So if you're one of the ones who are running low on cash, probably okay to just wait, build that cash up. We may dip down a little bit further, and then you can dollar cost average as we come out of it. I can definitely see the next couple of months are going to be rocky, probably definitely not any rallies of any sort that are going to take us to new higher levels. So you've got some time, save up the cash, just watch things. We're still so volatile right now that it may not make a difference whether you're in today, tomorrow, next week, next month. So again, monitor your own portfolio, do what's best for you. But I think we've got some time with the stocks still on the lower end to be able to invest and really get a good return on our investments. Let me know in the comments below, what do you think inflation is going to come in at next month? Do you think we're going to hit over 9%? Do you think we're going to hit double digits and hit 10%? Let me know your thoughts. Thank you so much for watching. I appreciate all of your support and feedback. If you have not subscribed, please do so down below. Sign yourself up for notifications. I am over on Twitter at OracleTim1. I share all of the latest Tesla news, pertinent stock market information, and all of my daily trades. Thank you so much. Have a great one.